Good morning or good afternoon, everyone, depending upon what part of the country you're in. We'd like to welcome you to today's webinar. So now that the first round of PPP funding under the CARES Act has been exhausted and the second round of applications are underway, although delayed because of some system issues with the SBA web portals, we thought it'd be a great idea for our friends at Citron Cooperman to provide assurance clients with strategies for calculating and maximizing PPP loan forgiveness. Many of you already know Citron Cooperman and the great work that they do for the staffing industry, but for those of you who don't, Citron Cooperman is an accounting firm with a large national staffing practice. They've been great friends of assurances for over a decade and have provided valuable support and guidance to many of our assurance clients for over the years. Presenting today from Citron Cooperman are three of the partners in their staffing practice: Michael Napolitano, Mike Zebrowitz, and BJ Hoffman. So with that, I'm just going to kick this over to you, Mike. All yours.
Great, Kurt. Thank you so much. Welcome, everybody, and thank you for joining us today. Hope everybody and you and your families are staying safe and sane. Again, special thanks to Kurt and his team for working with us to put this together. Kurt and Insurance have been, great partners with us over the years, and we welcome the opportunity to present to you guys. As Kurt has mentioned, we are a full-service staffing firm with a large concentration in staffing industry, and so we wanted to tailor this presentation to staffing companies to give you a kind of snapshot of how it affects the industry. The two topics that we wanted to cover today are kind of what's hot right now, and certainly a fluid situation given the news cycle. But right now, I think what everybody's concerned with is, one, the applicant eligibility in light of recently released FAQs. I think everybody's seen the news out there with Steve Mnuchin kind of talking about who's going to be audited and who's eligible and who's not. So again, we're not lawyers. But we wanted to kind of broach the topic with you guys. And the second is the loan forgiveness. So for many of you that have already gotten the loan or in process of getting the loan, we wanted to kind of walk through the process. And essentially what we're going to cover is, what are the assumptions out there already or still questions that are unanswered. We will go through an example with a forgiveness calculator. So it'll almost be a live example so you can see how the numbers work, or how we think that they're working. Again, there's still guidance to come out, and it has not come out as of yet. But as of right now, we'll show you how it works. Then we'll go through some strategies to maximize forgiveness and some other strategies as well. And after that, we will open it up to questions, and we can kind of go back. If you have questions about the forgiveness calculator, we can certainly go back to that as well. So that's kind of the lineup of how we're going to go through things. So again, on this will be myself, BJ Hoffman, and Mike Napolitano. We are the co-leaders of the staffing industry group at Citron Cooperman, and then Kurt as well, which many of you know. So to start today, I think Mike Napolitano will kind of kick off the eligibility concerns. And again, this is something that's been raised over the past few days, and again, there's not a lot of clarity to it, and hopefully there's going to be more to come out. But we wanted to kind of just walk through the recent FAQs and some things that you can do to cover yourself from this standpoint. So, Mike.
Thank you, Mike. So BJ, Mike, and myself had a front row seat to this train disaster called the PPP loan. So from day one, from prior to the release to the first day of the release, we've had the pleasure of being psychologists for most of our clients, being ones to try to interpret what the SBA and the federal government is trying to do. Again, from the first day, many of the payroll companies had the wrong calculation to determine payroll. We had issues with the banks, the process, and as of last Thursday night, we received many phone calls from clients very concerned about this new question that has been added. So last week, you all were familiar with the great press that some of our great restaurants received, Shake Shack and Ruth Chris, and then it was Harvard, and we just found out the LA Lakers all applied and apparently received PPP loan money. So the federal government is great at overreacting. And in question number 31, if anyone on this call received their PPP loan money in round one, this question was not part of your application. The first application really had one question about economic uncertainty. And every attorney that we spoke to basically said, yeah, there's uncertainty when your federal and states have closed down. So now they added this question, and it's kind of deceiving because when you read the question, do businesses owned by large companies with adequate sources of liquidity to support the business, most of my clients stop reading because they're reading it going, okay, we're not owned by a large company, move on and we'll answer this question. What's problematic is when you read the answer, it says, in addition, it's that next little, all borrowers must assess their economic need for a PPP loan under the standard established by the CARES Act. So, and if you read further, it talks about the current business activity and the business's ability to access other sources of liquidity sufficient to support their ongoing operations. So, for us, for the attorneys we know, for our clients, a lot of alarm bells went off because here's an example of another vague question by the SBA. One of my attorney contacts said their first-year law student could have written a better question that would have been more clear and concise. So unfortunately, it's forced us as the accountants to reach out to our clients and start having discussions about speaking to legal counsel because as Mike said, Mnuchin came out and started talking about criminal prosecution, their fraud, because when, is there good faith when you answered these questions? So unfortunately, it's made this process even more complicated. Many business owners are, I don't want to say reassessing their need, but are looking for guidance on what does this question mean? And unfortunately, Michael, BJ, and I have spent way too much time on this, and every week there's something new coming out that is even more confusing. So we are strongly urging that every recipient of PPP loans, or if you're in the process, if you happen to make it into round two, which is a whole other disaster on the amount of clients who have not made it into the program, and Mike and BJ will talk about the disasters with the banks. And as of last night, I was still assisting clients in trying to complete these loan applications. But it's going to be very important, and all three of us are going to stress this, is that you do a certain amount of due diligence in your documenting your need for this loan. And one of that is that we implore to everyone is speak to your counsel. I think it's very important to show the SBA, because remember, in 90 days, we're going to have to be sitting with the bank providing documentation for the forgiveness portion. But the SBA has come out with strong language in the last week about reviewing or auditing all PPP loans over $2 million. And I can tell you, I have two clients, two staffing firms that both received $10 million. And I have multiple staffing firms that received over $5 million. And I've had many phone calls with them and their legal counsel to have those discussions to make sure they're comfortable with question number 31. So this has been, again, Friday is when this came out. There may be some on this call who completed their loan 2 weeks ago, have no idea what question number 31 is. But if you listen to some of the politicians on the news, they're not even giving correct information. There's a lot of speculation. So for us, it's important to protect yourselves is to get that legal guidance regarding this question.
Yeah, Mike, and I think another thing that, you know, we're telling everybody is exactly what you mentioned. Document how the crisis affected, you know, your business, and document your needs for these funds. And so I think a lot of questions are out there. I think there's a lot of articles that have been posted as far as what does that look like, right? So, you know, how do you document, you know, uncertainty? Well, you know, if you have a decline in your available funding. So for a lot of staffing companies, that might mean asset-based lending, right? Which is, you know, you have a borrowing base based on eligible receivables. And I think that, you know, it's inevitable that payments are going to slow on receivables, and that's going to shrink your borrowing base, right? So I think that's something that needs to be documented. Are your clients in industries that are significantly affected by this? If you have alternative, you know, lending options, you know, would these utilizing these methods adversely impact your you know, your business and your operations? You know, any local or state restrictions that are certainly making it difficult. So I think that there's a lot of there's a lot of things that you can document to essentially to show what the uncertainty is, and although it's not required, I think it's essential now to document that. And like Mike said, refer to your legal counsel, get their thoughts on it as well. So so that's just, again, we could probably spend an hour on this, and there's a ton of ambiguity on it, but we just want to kind of bring it to people's attention. Next, what we're going to talk about, BJ is going to cover essentially here are the assumptions or the uncertainties that are still out there, and things that you need to consider when figuring what the forgiveness is. And then we will also use these in the forgiveness calculator. These will be implemented in there. So we want to talk about them before going through the calculator. So
I'm just going to add one thing, Mike. Some of the questions clients have been asking regarding that question is, like, does my business have to be down 10%, 20%, 30%? You know, if my headcount dropped by 5%, 10%, does that mean I qualify? And again, as with this entire program, no requirements have been released, no measurements have been released to determine what the impact has to be in order to qualify. So again, just to throw that out there, some of the questions we're getting.
And there was a deadline that the updated guidance is supposed to be released by April 26th. That came and went. All the politicians have left town. So if you're thinking it's going to come out this week, it's not. So early next week is probably at the earliest that any clarity is going to show up. And so obviously they provided a safe harbor date of May 7th to return the funds. It doesn't give people a lot of time to make that decision. But as of right now, everybody's still waiting for clarifications on updated guidance, especially with as it relates to forgiveness.
All right, so thanks, guys. And before I forget, thanks, Kurt, for hosting. You guys have been great, and the team at Assurance, you guys are awesome. So let's try and get into this a little bit here, and we'll proceed under the assumption that you're eligible. And again, reiterating what my colleagues are telling you, speak to outside legal counsel, document your eligibility, but let's move ahead and assume you got your funds and you're eligible to have received the funds. So it turns out there are still some questions on all of this, and this has just been particularly challenging for borrowers, for advisors. The rules keep changing every day. The rules, and I kind of understand, I get it. Government's trying to get money out on the street as quickly as possible, and things are rushed and stuff happens. But you know, the principles and the guidelines were so rushed, often contradictory, constantly changing on a day-by-day basis. And, you know, we just want to bang our heads against the wall sometimes because we want to be able to provide answers, and they're not always there. They're not there yet. So we say this a million times a day, it's fluid. So let's get into this now, and we're going to roll out a loan forgiveness calculation. We'll do a demo live in a minute. But before we get there, we got to cover some basics. Basics on our interpretation of what is going to be the driving factors for forgiveness, and understanding that some of this is still a moving target, and what we assume today may later be updated. And in fact, let's assume that it will be. So we're going to give it our best shot and offer some best practices and strategies. But first, let's talk about some of the underpinning assumptions that we've got here going on. So if you remember way back when you first applied, for those of you that have applied for PPP funds, way back in March, not too long ago, the first rollout of this program, one of the initial guidelines was, how much can you borrow? And everything was driven by historic average monthly payroll, gross payroll, right? For most of us, it's for the full year 2019, what is your average monthly payroll? And the initial guidance indicated, strangely to us, that it was going to be a net payroll factor that was going to drive your borrowing. So if you have an employee making a monthly gross pay of $1,000 and they're getting a check of $700 net, it seemed that early on that the amount that you could borrow and the amount that ultimately will be forgiven was going to be based on the $700 net paycheck. Didn't make any sense to us. But lo and behold, that's what the language said. And for a couple of weeks, that's what the assumption was. And some major payroll providers, the ADPs of the world, who were being helpful to their clients and preparing reports to assist in the borrowing calculation, were getting it wrong. They'd have these pretty reports and they're based on net pay. And ultimately, it turns out a couple of weeks later, gross pay is the driving factor. So we're happy to hear that, and we agree that gross pay is really the basis for all our discussions here. But interestingly enough, about 10 days ago, the SBA released a summary of the provisions to date and erroneously included reference to the net pay matter again. So that's just one example of how this is all over the place. But our assumptions are, and everything is telling us, this is going to be a gross pay calculation. So beyond that, what's the critical factor in ultimate forgiveness here? There's several potential debt forgiveness haircuts that you might be exposed to. And I'm going to talk about them, and again, moving target elements in each of them. First of all, there's a question of FTEs, full-time employee equivalents, in this calculation that you'll see. And without getting into too much detail, to the extent that your full-time employee headcount pre-crisis is higher than the FTE headcount after you receive the loan proceeds, you might be subjected to a loan forgiveness haircut. The question now becomes how do you define and calculate FTEs? And there's been no guidance to date on that. Everything we're hearing points to a calculation that mimics and is akin to the sort of calculation that you went through under the Affordable Care Act, which is essentially adding up your internal employees' hours worked on a weekly basis and your temps, your contract workforce, add up their hours, divide by 30 hours, and that gives you a weekly FTE headcount. That's the assumption we're going under. That's what everything's pointing to. Could it change? Possibly. Let's see. There's been some questions whether or not a staffing company's contract employees are or are not eligible to be part of this calculation. The answer with almost 100% certainty for once is yes, you need to calculate and work your headcount, including your temporary contract workers. We do note, and we should note, though, that the ASA, the American Staffing Association, is putting a full court press on Congress in lobbying, trying to get a carve out for the staffing industry that would, for the purposes of the debt forgiveness haircut, which we'll talk about in more detail, carve out and exclude your temp workforce. So to the extent that your temp workers are in decline post-crisis, perhaps if the ASA is successful, that would not result in a haircut to your loan. The ASA concedes that that's unlikely that they're going to be successful, but that bears watching as well. All right, so aside from this theoretical headcount reduction, that results in potential debt forgiveness haircuts for you. There's a couple of other tests that are going to be applied, and there's some questions about how those tests ultimately will be factored into a forgiveness calculation. To make things more complicated than they already are, we've got two separate other tests, both of which reference a 75% figure. And these tests have nothing to do with one another, but because they both rely on a 75% number, there's some confusion there. So let's talk about that real quickly. So first of all, what we call the 75% use of loan proceeds rule. So in theory, you need to use 75% of your loan proceeds on payroll in the 8-week measurement period in order to maximize forgiveness of your loan. So I'm going to use a crazy example for you here, just so that we're all talking from the same spot. So let's assume that you borrowed $1 million. That was your loan proceeds from the PPP. And then that starts the meter running on an 8-week period under which you need to spend those funds that will drive the forgiveness calculation. So you got $1 million. Let's say that in the 8-week subsequent period, you only spend $50,000 of that million on payroll. And let's say you spend $300,000 on rent, okay? This test, the 75% test that we're talking about, says take your payroll that you spent in the 8-week period, in our example, 50 grand. That 50 grand is 75% of some number, okay? By math, that 50,000 is 75% of $66,667, okay? That says if you only spend 50 grand on payroll during the measurement period of your $1 million, then only up to $66,667 of the loan can be forgivable. And the rest, it's $933,000 and change, becomes a true loan due back. So obviously you can see how important it is to spend the proceeds on payroll in the 8-week period, because that drives your forgiveness. Now, what I just set forth for you, that calculation, is what almost every advisor is believing that is the true calculation. But I do want to mention that there are some people out there that read the law to say that you got $1 million in loan proceeds. If you don't spend 75% of those loan proceeds, 750 grand, on payroll in the measurement period, then nothing is forgiven. None of your loan will be forgiven. We don't see it that way. Most don't see it that way, but we throw it out there because that's an assumption that we're making that we don't have hard and true guidance on. So that needs to be watched. Now let's set that test aside for a second and talk about another 75% test, completely unrelated, but theoretically resulting in a haircut to your loan forgiveness. This test is a test of individual employee salary compensation, okay? So essentially what it says is for those employees, internal and temps, that were with you both before the crisis and during the 8-week period after you receive your loan proceeds, to the extent you're paying those individual employees at least 75% post-crisis, what you had paid them pre-crisis, then no problem. However, if you're paying them less than 75% of what they had been making, there could be and there will be a dollar for dollar haircut applied to your loan forgiveness. It's important to note that test that I just mentioned to you, that individual employee by individual employee test, does not apply for fresh faces who you hire. It also doesn't apply to highly compensated employees, historic highly compensated employees. And for the purposes of this test, when you look back to the pre-crisis era, any employee who made more than $1,923 a week during that look back period, 1923 is the weekly equivalent of $100,000 a year, by the way. Anyone that was paid that in at least 1 week in the look back period, pre-crisis, is not part of this test either and will not cause any loan forgiveness haircut. So an executive who's making $500,000 a year pre-crisis and is making $150,000 a year post-crisis, that reduction in their individual pay is clearly more than 25%. But it doesn't matter, there's no haircut because they are highly compensated. So again, there's going to be more guidance coming out on that, but that is the third test, potential loan forgiveness haircut test, that we are keeping our eye on. Just a few other things before we get to the actual calculator. How about if you use loan proceeds for ineligible costs? Let's say you go out and you spend $300,000 on a boat, right? Clearly not eligible. There remains the question as to whether that just means that you, those dollars that you spent using PPP funds are just due back like any other loan, or whether because you used the dollars for ineligible purposes, whether there might be an immediate payback required. That's something we're watching. A couple more items here. And this will come into the strategy piece. Remember, you received your loan proceeds and you've got 8 weeks essentially to spend those proceeds, right? The question is you need to spend those dollars in the 8-week measurement period. But do those expenditures that you're making in the 8-week period, do they need to relate to expenses that were incurred during the 8-week period? That's a key question. So by way of example, right? So you get your loan proceeds and the 8-week clock starts ticking and you're coming down to the end of the 8 weeks and you haven't spent your money and you think to yourself, how about if I prepay 8 months worth of rent or a year's worth of rent just to shoehorn that into the 8-week measurement period? Or how about if I prepay year-end bonuses and get them into this week period to use up the funds? Got to be careful because we believe that that's going to be an area that will merit attention from any audit. You really need, our belief is that you really need to spend the dollars during the 8-week period in the ordinary course of your normal conduct. That a big prepayment of expenses before the end of the 8-week window would not be looked upon favorably. Similarly, if you're trying to pay expenses that were incurred in 2019, say delinquent 2019 payroll or back bonuses, that probably wouldn't be viewed favorably either. So there's going to be, in all likelihood, an attempt to get you to align your payments during the 8-week period with expenses that are being generated within the 8-week period. There's still some planning opportunities there, but you don't want to be abusive. Finally, I talked at the outset about this full-time equivalent headcount haircut potential. So if you come in to the 8-week period after you received your loan proceeds and your headcount is lower than it was pre-crisis, we talk about this theoretical headcount haircut to your debt forgiveness. Well, there is a provision in the Act that says that if you restore your headcount to pre-crisis levels by June 30th, 2020, that loan forgiveness haircut will not take place. So that is something for sure to watch and to see whether we can use that as a mechanism by which we can maximize our loan forgiveness. So with that, I think you've probably listened to me far too long. We'll actually run through some examples here. An example, and Mike, I think, is going to take us through.
Thank you, BJ. And everybody uses the boat example as ineligible cost. I think we should all get into the boat sales business because apparently everybody's going to be buying boats with these PPP funds. So, yeah, as BJ said, we want to walk through a calculator. So, again, this is more of a live example. This calculator isn't anything official. It's something that we use internally. We will be posting this calculator live on our website, and we'll share the link for you guys. I don't think this is any kind of support that should be used. It's just to give you an idea of what you can expect and kind of guide you through it. As BJ mentioned, there's a ton of assumptions that are going into this, but we wanted to give you an example on on how a model might work given where things currently stand. And so I will, let's see, pop this up. Can everybody see this? Yes, good. All right, good.
Yeah, you look good. You look good.
All right, good. So again, this is an internal calculator that we kind of took and developed. There's probably similar calculators out there that some of you might have seen, but we wanted to use this calculator to kind of walk through an example, a real life example. So where we start, is essentially, at the loan date. So this is something that's kind of unanswered at this point. I think the terminology is origination date. So some people are like, does this mean when I get my funds? And I think that's generally the case. Just make sure that the loan date matches when you got your funds. If there's a discrepancy, you might have to defer to the loan date since it's official. But again, something to kind of keep in mind. It should be right around the same time. And then you have 90 days from that date to submit your forgiveness documentation, whatever that looks like. I want to skip this first section down here just because numbers 1 through 3, it's essentially the FTE haircut. We'll get through to it. But skip down to number 4, and then this is going to be your loan amount. So we use the number $1.3 million as the loan amount. As BJ said, what's important is what you spend, the eligible costs during the 8-week period. That's going to be number 5. That's going to be your starting point before, haircuts 2 and 3, which is the FTE and the dollar for dollar. So that comes from this right here. And this is essentially the 8-week period, what you spent during that 8-week period. Again, it's gross wages because that's the way we're seeing it right now. That might change to net, right? But the 8-week period starts essentially a week after, I guess, you get your loan. And the logic there being that, if you got the loan on a same date that you were making payroll, that payroll is probably for a prior period. So to the extent that it's paid and incurred, that payroll period would not have been incurred. So it wouldn't factor in here. Again, a lot of assumptions. So you have your gross payroll, you have some reductions, $100,000 cap, any people that are outside the US, anybody that received any FMLA or sick pay money, that gets excluded. Add back your health insurance employer portion, add back employer's portion of state unemployment, add back any employer match or pension plan. And we'll talk about this as a maximizing strategy. Make sure that you include all this to maximize what your payroll costs are going to be. Then you have interest on mortgage obligations. There has been talk about what about interest on other debt. That was included in the calculation of the loan, but we have not seen that in the forgiveness portion. So there is that discrepancy. So for now, that's out. Payments on covered rent obligations. Now it's what about on leased equipment? Does that get included in there? Again, right now they don't break that out. But let's just go under the assumption, that it's rent obligations for office space. Again, it could be on equipment. They haven't detailed that. And then utilities. Utilities are defined in the CARES Act. We kind of broke it out there to the best that we could of what would be covered under utilities. So you have each week listed out there. On the bottom, you also see the number of full-time equivalents by week. That is then averaged out during the 8-week period. And now we'll go into the FTE haircut. But so essentially at the end of the 8-week period, you're going to have total payroll and non-payroll costs. So at the end of this, you had $927,000. As BJ said, this is haircut number 1. I do want to caution and say that the ordering of the haircuts has not been established. So we are saying this is haircut number 1, but again, that's not known. So the order could change. But for now, we're saying this is the first haircut. This is the 75-25 payroll versus non-payroll costs. So in our example, during an 8-week period, we had $657,000 in payroll costs and then $270,000 in non-payroll costs. Obviously, the non-payroll costs are greater than 25%. So there has to be a haircut. So the haircut reduces the non-payroll costs and the overall eligible costs go down from $927,000 to $876,000. Again, this is the first haircut. This is the, for the non-payroll costs. Using the payroll cost as the anchor is going to reduce anything that's over 25% non-payroll. I also want to point out that for anybody making over $100,000, the cap during the 8-week period is $15,385. That is essentially 100,000 divided by 52 times 8. So during your 8-week period, anybody that, you know, that is over that the threshold is $15,385 during the 8-week period. However you kind of get there, but that's what it is. All right, so we'll take this $876,000, and then this is what's eligible costs during the 8-week period, and that's essentially what the maximum forgiveness amount is, the way we read it. So then you get into your first FTE haircut. And so we said their average FTEs were 66 during an 8-week period, and then you have 2 look-back periods, okay? And it's your choice which one you use. And the first one is what's your average FTEs from February 15, 2019 to June 30th, 2019, or you have the option of using the first 2 months of 2020. If you were already in the process of reducing, you know, operations, that might be the better one. But again, the 66 is your numerator. The option of these two is your denominator. The one that suits you better is going to be, you know, the ratio reduction. So in here, 66 over 80 is essentially 83%, which means that there's a 17% haircut that needs to be taken due to reduction of FTEs. So this $150,000 reduction is essentially 17% of the maximum forgiveness amount. So that's haircut number 1. Haircut number 2 is a dollar for dollar reduction for individuals. Now, people come up with the question, do I have to list this out by person? Right now, that's the way it seems. And so do you have to list out each single person? Probably not. Maybe if you know that, you know, you essentially cut somebody's salary. So on the temp side, on contract employees, you're probably not cutting people, their rates, but you might be. So here's the calculation. It's essentially what is the person's compensation during an 8-week period versus what was their rate during the quarter leading up to the crisis, okay? Column G is essentially the allowed deduction. And so the difference minus the allowed deduction is any excess over what's allowed. And again, that's a dollar for dollar reduction. As BJ mentioned, if anybody during any period in time in the look back period, it could be a week, it could be a month, aggregated made over $100,000, they're excluded from this calculation. They're not included in there. Questions have come up. What if I fire somebody before and then I hire somebody different? Again, the guidance is not clear on that, but make the assumption that this is, you know, we're going under the assumption that these are people that were present during both periods and that their salary, you know, wasn't reduced by more than 25%. So again, a lot of questions around this, but then this, we calculated here, there's about $3,800 in dollar for dollar reduction. That goes here. And these 2 reductions, also following the initial reduction, would kind of get you to $722,000. And then this would be eligible for forgiveness. The remaining balance is going to be kicked back to your loan, and that loan is going to be payable over 2 years at 1% with a 6-month payment deferral. So again, kind of how we see things right now. When the updated guidance comes out, it could change some of these assumptions, some of the ordering, obviously, but the way things stand now, this is kind of how we see it. And again, to the extent that people have questions, we'll come back to this at the end. And so I'll reshare the, we'll go back to the presentation, and I'll kick it over to Mike Napolitano. And so Mike will talk about some strategies, which we slightly covered, but he'll go into a little bit more detail on how to maximize forgiveness.
Thank you, Mike. I'm just going to add regarding that forgiveness guide. So over the past couple of days with conversations with most of my staffing firms, they are down, and they forecast for the next 8 weeks, they will not recover. I have some staffing firms that are down 20 to 50%. I have several that many of their customers are in the retail space, which we know will not recover. So what I suggest to everyone, what's great about this guide is you can populate your anticipated payroll over the next 8 weeks. Because the number one question we're getting is, well, how much of my loan do you think will not be forgiven? So this is a great tool, and it's a living, breathing document that we can update every week as you're incurring the payroll. So it could give you a roadmap as to what may or may not be forgiven. So it's a great tool that you should incorporate into your planning for this, potential non-forgivable portion of the loan. So many of our clients will be updating this weekly in hopes that their head count will get up, because the other unintended consequence that many of our clients are dealing with is with unemployment being so favorable. I have firms that actually have positions to fill and they can't. Other questions that have been asked is, in this very difficult environment, can I increase the commissions, provide incentives to my recruiters? Is that okay? And what Mike said is, what would you do in the ordinary course of business? So in this environment, if you are trying to incentivize and offer more dollars, again, I'm not an expert in that, but I think that would fall under the ordinary course of business. So there are some unintended consequences with some of the relief packages, and I know many of my clients are having a difficult time actually placing individuals because the unemployment benefits are so good. Others have kept on some of the temps in an attempt to meet some of the payroll requirements. So there's a lot of discussions you should be having with your professionals on best ways to manage this, because unfortunately we're just seeing this as being a much longer period of time that this is going to continue. And another question that was raised from a client is, who has not received the money yet. Remember, the 8-week period ends as of June 30th. What if we're on a 2-week payroll cycle and that last week of payroll is in July as opposed to June 30th? What's the impact? Because the payroll actually isn't going to get paid into July. I fear to use common sense anytime you're dealing with the federal government, but if that last pay period did fall into July for the week ending June 30th, I would like to hope that would be included as being paid during the period. So as this is happening, as BJ and I are talking to our clients, there's a lot of great questions. I had a client ask me, can I include hazard pay? In the tri-state area, we've seen talk of certain government agencies, other employers adding hazard pay for individuals who are coming into work. So these are all great questions and considerations we need to talk about on if you are adding that. Is that an expense that may be viewed differently by the SBA? So all good questions. So I'm just talking about real quick minimizing forgiveness. We're in week 4 of this loan. I have a feeling most people on this call have been through what the allowable expenses are. So obviously, point number 1 is spending the loan proceeds on payroll. The including the $76.92 per month is for anyone out there who's an LLC or a partnership. You are allowed to also include up to $100,000 of your earnings as part of payroll. So this was an opportunity for some of our business owners to have some of their income covered by the SBA. So you were limited to $7,692 per month for your income. So one of the recommendations we're making is to remember you're having a banker review your information at time of the review of what's forgivable. And our philosophy is to try to make it idiot proof, because these bankers are going to be overwhelmed. We spent a lot of time on the phone with bankers trying to get their perspective. I've been told many of them are going to be very robotic. Here's the guideline and what we need to do. We have to have a file just like they do for all loans, and they're going to check the boxes. So it's our intention that everyone have the information in a manner where you're not explaining things. Here's the support. Here's the $7,692 payment per month for myself and for my partners. So it's clearly identifiable. It's going to be extremely important that we're not having conversations to explain things. So we're asking all our clients to have, a loan forgiveness file where you're keeping copies of your rent, your utilities. If you have a separate bank account, which is one of the practices we're really pushing, is from that account, as you're incurring payroll, you're transferring the money in. As you're incurring rent, utilities, you transfer it in. We want to make it idiot-proof for the bankers. The second point is obviously we want to get all the payroll in within that 8-week period. There is talk. The hospitality industry is really pushing to increase that 8-week period, just because in many parts of the country, especially where I am, where most of us are in the Northeast, we're closed down. So there is certain industries that are really pushing to increase that from an 8 to 12-week period. Apparently, a client called me, Senator Marco Rubio was on this morning and mentioned something, as long as you use it for payroll in the next, couple of months, that it could be forgiven. So there's a lot of misinformation. A lot of politicians are making comments, but as of right now, it is the 8-week period. The third point gets back to what I just discussed. If you're an LLC, is we are suggesting that the members do pay themselves the $7,692. Again, a clear path for the bankers to see what the money was used for. This one, bringing staff back early. So again, as we mentioned, there's several tests: the full-time equivalent test, the wages paid test. So in managing the forgiveness, again, you have internal employees, and you have to look at, did you reduce your internal employees' salaries greater than 25%? That's going to impact the calculation. If you laid off internal employees, bringing them back will help with the loan forgiveness as well. So you have to weigh what's best for the business, what's best for loan forgiveness at the same time. So we have to look at that. And the last point, if it's impossible to spend the 75% on payroll costs, then basically understand, and this is the conversation every single client, whether it's staffing or not, I start off with assume 100% of the loan will not be forgiven. It's just a matter of what percentage won't be forgiven. If you incorporate our loan calculator guide, it provides you a really good mechanism to help you manage that. Real quick on the full-time equivalent, just understand there are two measuring points, because as BJ mentioned earlier, you're looking at your full-time equivalents pre-crisis versus June 30th, but there are two periods you can measure. You can look from February of 19 to June of 19 versus the beginning of this year. Obviously, you want to pick the period with the least amount of head count. So when you're comparing in June, it's more favorable for yourself. The next 2 points, unfortunately, there's not much we can do now. With our first round of applicants in early April, the idea was if we could somehow delay the receipt of the funds, allowing the economy to open up a little bit. But the reality is, once your SBA loan gets through the bank and passed to the SBA, we've been told it's a 1 to 4 day turnaround time, and there's nothing you can do to delay that. And again, the last point, if they're received earlier, you can still bring back most of the employees by June 30th. So there is a lot of planning that has to take place on what's best for loan forgiveness, but also what's left for the business. I've had some clients say, I'll bring everyone back by June 30th, and then I'll lay them off, sometime in July. Again, this is getting a lot more scrutiny in the last week or two. So I wouldn't suggest that. If it doesn't look good, let's use some common sense. If you bring everyone on and then you're laying them off over the next 4 weeks, probably not the best strategy. And finally, returning people, the reason why we're saying pay them at 80%, it's that 75% rule. Once you reduce anyone's pay greater than 25%, you are exposed to a portion of your loan not being forgiven. So again, planning is key. There are tools out there to do that. And again, work with your professionals as well.
Mike, real quick, because a couple questions came up and BJ and I touched on this. I just want to be clear about it. When we talked about, ineligible people pre and post, and we talked about fresh faces, some of that, anybody over 100,000, that just related just to the individual haircut calculation. So when we talk about, it's not that they're not eligible for forgiveness. When you're calculating anybody, when you're calculating that individual haircut forgiveness, anybody that made over 100,000 during that year or any point in time, they're just not including in that haircut calculation. I don't want to confuse it. Same thing with, if you bring people back or if the people don't span both periods, again, that's just for purposes of that calculation, not trying to say that if you bring somebody back, because obviously that's the whole purpose of this program is to bring people back. It's not that they're not going to be eligible for forgiveness. It's just specific to that individual calculation. So again, we're running out of time. We want to leave this open for questions. So BJ, if you just want to run through real quick some other quick.
Yeah, I want to be cognizant. There's a lot of questions. There's probably no way we're going to get to them all. So I'll get through this screen in 5 seconds, maybe. So best practices: try and open up a separate bank account for your loan proceeds. It provides a better audit trail. And segregates the funds in the event that someone's looking over your shoulder. Same for point 2. Assume somebody, is going to be looking over your shoulder. So document the use of those funds, keep payroll records, show what each disbursement was for over the 8-week period. To be sure, avoid extravagant purchases during the 2-month window from a scrutiny standpoint. The 13-week rolling cash flow, I think it's really important to realize that you're getting a big slug of funds, of loan proceeds, and you need to do something with them theoretically within 8 weeks. And you spend the money the right way. So you don't want to spend the money too quickly. You want to spend it on the right things. So it's important to do a cash flow analysis, and certainly your advisor should be helping you and holding your hand through that. Finally, I'll be quick on this one as well. So the notion, there's this other, separate and apart from the PPP program, there is this opportunity for employers to defer payment of the employer's piece of Social Security payroll taxes to the government from March through the end of 2020. That's effectively an interest-free loan because you're not obligated to pay it. Half of that amount will be due at the end of 2021. The other half will be at the end of 2022. So it's an interest-free loan. You cannot make use of that incentive if you are in the PPP program, and this is the key piece of it, and you have debt forgiven. The important thing is you can make use of this deferral, this Social Security tax payment deferral up until the time that you have PPP loans forgiven. So you can't participate in both, but you can participate in both plans until the moment, whenever that is down the road, September, October, when you get officially notified that you're have a piece of your loan forgiven. Then you must halt the payroll tax deferral. So just keep that in mind. All right, questions and answers. Mike, how are we gonna do this?
So there's a couple of questions. One, I think, Mike, another Mike, and believe it or not, there's another Mike on this panel, or not in this presentation. Ask this question: if we have a line of credit with the bank, the PPP loan automatically swept and paid down the line, which saves us on interest expenses. Is this okay as long as we can easily account for or restore any sweep amount at the time of the term of forgiveness? So this is kind of the reasoning for saying to open up a separate bank account, because obviously pay down of debt is an ineligible payment. So and again, this was kind of with asset-based lending, you have a lot of these triggers that either are swept or automatically paid down. I think it's important to in order to avoid confusion, to have a separate account, and so it's not seen as, oh, well, I got a loan and I paid down my debt, and now I'm going to be collecting on old receivables, and that's going to be what's going to be used to pay. I think that would be difficult to justify. So again, I think that goes to PJ's point of opening up a separate account.
Yeah.
Hey, Mike, can I jump in here real quick?
Yeah, go
guys? Since we do only have a few minutes left and we've got over 30 questions, what I'm going to suggest is maybe we go another 5 minutes or so, 5-6 minutes, because there's no way we're going to get to 30 questions. But what then I would ask the attendees to do is, we've got a record of the questions. If you have additional questions at the end of the webinar, forward them along to your assurance contacts. We will consolidate those questions into an FAQ. And if it's okay with you guys, we'll run it by you, and maybe we can publish an FAQ after this to our customers by the end of the week. Does that work?
Yeah, again,
That's great.
Yeah, Francis, I think, and there's a couple of questions, and again, we wanted to clear this up, and it said, did you say that new hires do not count towards loan forgiveness? That is not what we meant. We meant that new hires might not count towards the haircut, the individual dollar for dollar haircut. Obviously, they would count for loan forgiveness.
Yeah. Yeah. You get credit for them for the loan forgiveness. It's just they are not part of that third haircut test that we showed you, the individual by individual test. So,
Tom asked he asked about the calculation. So, why isn't it $8,333, per month? Essentially, Tom, it's the calculations on a weekly basis. You're dividing the 100,000 by 52 weeks, which gets you the lower amount per month.
1923 times 4 weeks gets you to the 75, whatever the figure was that we shared with you.
Correct. Let me switch over. So that was in the chat. Let me switch over to, so there was questions about, let me scroll up. I saw a question about companies asking, let me see if I can find it. Is there any staffing agency requests from other clients to share PPP loan funds in the form of rate concessions or credits, since the client is reimbursing the staffing agency for payroll costs that the loan is based on? So again, this kind of goes back to under a traditional SBA loan, and Mike Napolitano and I talked about this. If you're a warehouse and you're applying for an SBA loan, you can technically take credit for temp employees. Under the PPP loan, that is not the case. The temp employees belong to the staffing agency, and the ASA made this very clear. And so so I don't know that they would have any claim to share in the PPP loan funds. This is just the way the program is established, and I haven't heard this from any of my clients. Mike, let me know if.
I had that question from several staffing clients, and also they raised the question, can people find out if we receive the PPP loans? And the answer is yes, because under the Freedom of Information Act. But again, if someone's going that route, they're really digging to find out. But it is a concern. We have yet to have any of my clients, none of their customers have reached out to them about sharing. During this period, they've been asked to discount to reduce their fee just because of what we're going through, but nothing specifically related to this loan.
Got it. There was a question, and we kind of glossed over this, and this was big for staffing agencies. How are companies with over 500 temp employees qualifying for the PPP loan? This was kind of a game changer when one of the FAQs came out. Essentially, in the beginning of the program, it was just, hey, anybody with over 500 employees is no longer eligible. There came an alternative size standard. And so what that said is that if your company is below 15 million in net worth, which is assets minus liabilities, and I think this is on a tax basis. We had questions on whether this is tax or book, but let's assume this is on a tax basis. If you're under 15 million net worth, and over the last 2 years, your net income after taxes was less than 5 million, average last 2 years, if you meet those two criteria, you are in. So it doesn't matter how many employees you have or how much revenue you have. That's the alternative size standard. And then that came out, I think, end of March, beginning of April.
Yeah, I think it was like April 8th, and it opened up the flood.
Yeah.
Staffing staffing firms to.
And then, yeah, in the beginning, I mean, this obviously threw everybody for a loop because that opened it up to a lot of people then qualified and were able to take advantage of this. So that is something that we talked about. If gross pay is the amount for loan calc, do we also include state tax withheld for employees in what is paid for PPP dollars? So essentially, that is the calculation is it's gross pay, meaning you're including the employee's portion of federal and state. You are also adding in employer's portion of state unemployment to that gross amount. So what is not included is the employer's portion of payroll taxes, and that's not eligible for the loan or for forgiveness. There's a couple that we talked about. Can we hire new team members to replace? Yes, you can obviously hire new team members to replace. Again, just don't include them in that dollar for dollar haircut, but obviously they are eligible for forgiveness. A couple more questions again that came around the same time about the fresh faces. So I think we addressed that. Can we get a blank loan forgiveness guide? Again, we're going to make that eligible. You're just going to need to sign in and you'll be able to use the guide on our website. Some accounting firms have indicated that they believe workers' comp costs are included. They are not. Workers' comp, disability insurance, and I believe life insurance are not included, are not add backs. So that is a no. Calculator would. What would prohibit?
Just real quick with that, Michael, I actually had two banks when my staffing firms were applying, actually asked initially for them to include the workers' comp as part of the gross monthly payroll. We actually provided the information to the bank that you don't do that, and they then took that and applied it to their future customers. Again, we didn't want to increase the loan any more than we were allowed to, so that is not included.
Hey, one other point on that real quick too. The NCCI in several states are providing guidance that they're going to exclude wages paid to furloughed employees, non-working employees that you do bring back onto the payroll, which is essentially the spirit of the PPP loan package, that is going to be excluded from wage calculation for workers' comp purposes. So keep those records separate. We suggest moving it off into a separate, if your software system allows you to assign workers' comp codes to payroll, move it off into a separate workers' comp code. Either call it 999 or 000, or you can call it PPPP. Whatever you do, segregate it off. It's going to need to be proven up when it's time for the audits by the insurance companies, but that will provide relief from workers' comp burden related to those wages.
Got it. Couple of questions. There was a quick question. Would anything prohibit people from hiring family members? I don't think so. I don't think there's anything in there. I mean, obviously, we talk about ordinary course of business. But,
right. Be careful. Be careful there.
Couple of questions about, and again, we want to be clear about this. For employees paid over 100K per year, is anything over 100K unforgivable, or is the employee's pay excluded? Again, for that forgiveness calculation, anybody that made over 100K, they're excluded strictly from that calculation, that haircut calculation. And as far as forgiveness, anything over 100K, anything under 100K rate is forgivable. Anything over 100K rate is not.
Right. I did see a question on whether the employer's share of health insurance is an eligible expense. Forgiveness, yes. The answer is yes.
Gotcha. Follow-up question. Do new positions with new people or people count towards payroll? Yes, they count towards payroll. They might not count towards that haircut that we keep referencing back. Again, I apologize for that confusion. It's strictly for that haircut calculation that new faces would not probably count. We talked about the sweep. Is the FTE forgiveness an average over 8 weeks or only as of June 30th? So it is an average over 8 weeks. However, if you get everybody back to pre-crisis level as of June 30th, then I think that 8 week gets disregarded. Again, lack of clarity there. People have said, well, listen, can I hire people back from the 8-week period and then fire them again and then bring them back on June 29th? Probably not a good look, and I'm not sure how that'd be looked at. But again, it's use the 8-week period as a guide, and then if you can get everybody back by June 30th, I think that haircut for FTEs should go away. Could you return the portion of the loan that is not utilized? Correct. Yes. There's no early prepayment penalty. You are able to pay that back without any penalty. So to the extent that you don't use it, you can pay it back early and not have to incur it over any interest on it. You keep mentioning June 30th is an 8-week from when you receive the loan proceeds. It is, again, there is that provision that BJ mentioned, that is that 8-week period. However, if you restore both your pay rates and your FTE headcount by June 30th, those two haircuts go away. Again, it's written real quirky, and it could get extended. Mike mentioned that there is hospitality industry and some other industries are trying to extend that period.
But just to be clear, if you get your loan proceeds on June 15th, you still have 8 weeks to spend the money. But June 30th remains that date to restore your headcount to pre-crisis levels in order to avoid that haircut that's theoretically out there. So,
got it. Let me see. Are FTE calculation periods by week, month, or your payroll period? So for forgiveness portion, we would calculate it by week and then just take the average for the week. Again, it's average FTEs, for the look back periods and for the forgiveness portion. Again, how we're reading it. We calculate PPP on full-time employees excluding temps. When we apply for forgiveness, can we use the same formula? Yeah, I think that in that situation, if you excluded temps, I mean, I think that your loan is obviously a lot lower than it could have been. You can certainly use. I believe you should be able to use that formula. I think the issue, I guess, would be for the forgiveness portion, if your temps went way down, but your full-time employees stayed the same. Mike, what are your thoughts on that as far as if you only factored full-time employees in your loan calculation, how would the forgiveness get calculated? Would you include temps in the haircut if the loan wasn't used for that?
Again, vague, but I think the way it's written is you include the temps as well. So at this point, that's what we believe you do.
Yeah, I agree. I don't see any exclusions of that. So
No.
it's difficult. And again, BJ mentioned ASA is trying to do something for that,
right,
possibly to exclude contract employees from the haircut. I don't think they're trying to exclude them from the forgiveness,
no,
from the haircut calculation.
ASA wants the best of both worlds, as they should, to count their, payroll towards forgiveness, but to exclude the contract employees from the haircut calculation. So, I don't begrudge them for trying that.
Right. Here's one. We are in healthcare staffing. We have a small subset of 1099 professionals that are on contract. Our loan was approved before SBA mentioned that 1099 should not be included in the calculation. They are paid through ADP, so the portion will be eligible. Would they be eligible for forgiveness? Without it, we would not hit the 75% threshold of the loan being used for payroll. So two things there, and BJ and Mike, you can talk about the 1099. When we talk about the 75% threshold, again, we don't read it as it needs to be, if you get $1 million loan, you don't have to spend $750,000 for anything to be forgiven. If you want the max $1 million loan to be forgiven, then yeah, you would have to spend $750,000. But whatever you spend on eligible payroll costs, that is going to be eligible for forgiveness. The rest of it's just going to go. As far as the 1099s, BJ, you want to?
Yeah, no, it's pretty specific right now. 1099s don't count. couldn't borrow on them. You know, you couldn't ask for loan proceeds based on them, and you can't count costs, you know, that you're expending on them as far as forgiveness. That's not an eligible cost. You know, I've heard, and I wouldn't recommend this, but I've heard people suggest converting 1099s to W-2. But again, you're talking about, you know, during the 8-week period, but you're talking about taking steps that are not in the ordinary course in order to maximize your loan forgiveness, and you expose yourself to scrutiny and issues if you do that. But I've heard the question asked, so.
Right. Can you pay employees who are furloughed or given pay reductions retroactively up to the amount that would satisfy their losses? So it's two ways to look at that. One, from a haircut standpoint, yes, I think that, you know, you would be able to what if you restore their rates by June 30th, then you would not lose that haircut. If the question is whether you would be able to pay them for back pay in order to make it eligible payroll costs, BJ, Mike, thoughts on that?
Yeah, I would be careful on, you know, paying back pay, paying a lump sum, anything out of the ordinary course of business. So not sure if that would be accepted when this is looked at, because just I want to bring up real quick, because this issue came up on the loan forgiveness, but also the audit, especially if you're over $2 million. So one of the concerns we had internally is these audits are going to take forever to be completed. It could be 3 months, 6 months, 9 months, a year. So the conversation grew into, well, okay, if at year end, you know, the economy turned and we're doing favorable and we have $5 million that we want to, you know, distribute bonus out, is that going to be looked unfavorably by the SBA when they audit you? So no answer, but these are questions that have been raised for those businesses that were told that if you receive more than $2 million, you're going to be audited. Well, again, we don't know when that audit's going to happen. We don't know how it's going to be viewed. If there are large, you know, if there's large income this year, bonuses are paid. So just keep that in the back of your mind as we learn more about the audit process, which we don't. This is the information we keep passing to our clients, and we'll pass along to you as well, is just so you're all prepared for this.
Mike, are you guys okay if I mean, we're already 15 minutes
Yep.
past the end time, and there's still probably 30 questions unanswered. We can keep going for the next
right.
2 hours likely. What I'm going to suggest is we have a list of the questions that are remaining unanswered. If anybody on the webinar has additional questions or other thoughts as a result of what was discussed today, I'd say funnel it through your assurance contact, and then it'll all be channeled through me. We can consolidate those into something that's more manageable for the folks over at Citron, and we can publish something back to everybody later in the week. The recording is going to be made available to all recipients, so you will be able to go back and review what was presented. I will say, if let's just say in the next 24 hours, and I don't know what Maria's timing is on getting the recording out, but it's usually available within 24 hours. If you don't receive it, likely got caught in your spam filter someplace. Go in and check your spam filters, see if it's there. If not, again, reach out to the folks at Assurance and we'll make sure that we get it for you. I do want to sincerely thank the three of you for your time and your effort. The issue is complex. It's crazy and it's as clear as mud, and we know that it changes on a day-to-day basis. So your guidance and your support for your customers, and specifically for the Assurance customers, is incredibly appreciated. If anybody's interested in getting a hold of these gentlemen, please contact us. The contact information is there on your screen. But again, these guys have been friends of mine for 10 years, and I trust them with my most valuable customers. We would trust them with you as well. So thanks to everyone.
Thank you, Kurt.
Yeah.
Thank you. Thanks
Absolutely.
very much. Yeah.
All right, that's it. We'll call it a wrap. Thanks, everyone.
Thank you.
Thank you.
Bye-bye.